Okay, first this hour, mortgage lending by the high street banks fell in October and is now at its lowest since February 2001. The latest figures from the British Bankers Association show that a total of £7.6 billion was lent in October. Sounds a lot, doesn't it? But it's down, in fact, from £7.9 billion in September. The number of mortgages approved also fell to a 19-month low. But the UK's third largest lender, Nationwide, which reported today, says that while house prices are likely to remain under pressure, falls will be modest in the year ahead. Jonathan Davis is an investment advisor and joins us now live from our studio in the Gherkin. Now, Mr. Davis, you have been forecasting a crash in the housing market for some time. Do you now accept that that is not now going to happen?
No, I certainly do not. Historically, we went into our crash a year after the United States. So when they did their money printing, or they called it quantitative easing 1, in early 2009, they were already down 20–30%, whereas we were just going into it at that point. Now, so when we did our quantitative easing, our money printing, that boosted lending for a short while. What we have now is that, looking at the Nationwide and Halifax figures, we're approaching negative numbers year on year. We're practically at 0% annual growth. Rightmove, which is what most people take for asking prices, was down 3.2% just last month. No, inevitably, as volumes have plummeted, prices will follow.
OK, but the falls that we've seen so far in the most recent trends are pretty modest, to put it mildly, and it doesn't necessarily follow, does it, that a slowdown in activity leads to a fall in prices. Nationwide's argument, which is a convincing one, surely, is that low interest rates means at the end of the day, sellers who don't like the price they're offered don't have to sell, so prices don't fall.
You know, how often for years did we get told if only interest rates would come down and house prices would rise and rise? Well, interest rates are at their lowest, as everyone knows, in recorded economic history. So why aren't prices rising 20% a year? Because there is no lending out there to speak of. The banks are technically insolvent. That's why they're restricting lending.
Okay.
And that's why we see the lending numbers that you mentioned there.
Just want to cut you off, Mr. Davis, but the fact is,
therefore there's no real demand. Therefore, house prices will fall.
Okay. The fact is that only 5% of home owners in the UK are in negative equity, compared to 23% in the United States. We have seen unemployment stabilise. We have seen levels of repossessions which are lower than many people expected and are actually falling. So by predicting a crash, some people would say you're just simply scaremongering.
Well, that's certainly not my intention. I would not agree with you that unemployment has stabilised. We've just seen public sector cuts, and unemployment's going to go up between 500,000 and 1 million over the next few years. There's not going to be any serious lending going forward because, as I say, the banks are technically insolvent. Whatever demand there is out there, there's no real demand because there's no money. No, inevitably prices are falling right now. They hit another peak in the summer of this year. Within 2 or 3 months, they'll go negative year on year, and they'll be negative for the next 2 or 3 years.
OK, Jonathan Davis, that's your forecast, negative for the next 2 to 3 years. We'll stay in touch.